the other thing that I really had going for me was that I was out in the field doing this every day. Like I was dealing in properties and doing deals with agents, and I knew how it worked on the ground. And I think that's where a lot of property books didn't come to the party. They told you a lot of theory, and then they kind of were like, okay, off you go.
Welcome to the Get Invested podcast, where we share conversations I've enjoyed with experts from all walks of life to uncover their secret know-how on where they invest their time, their skills, and their money, and the benefits this has created. Get Invested helps you to live more, work less, and leave a legacy by investing now. Listen to the show to discover top tips on how to get started, to make the most of your investment journey, and ultimately to be living the dream. More episodes can be found on iTunes or at khgroup.com.au/Get Invested. Thanks for listening, and let's get invested. I'm really excited today to have an opportunity to have a really in-depth chat with someone I've got an enormous respect for, Josh Masters. He's a leading buyer's agent and a specialist in property investment. Welcome to Get Invested, Josh.
Bushy, thank you for having me. It's great to be here.
No, really am looking forward to having a deep dive, mate. You've done a lot already, both personally and in the business of property. So, look, mate, rather than me try and regarble what you do, tell us who you are, what you're doing, where you're heading, mate.
Mate, I'm obviously a buyer's agent. I have offices here in Sydney and in Brisbane, and look, we're just about to open up in Melbourne as well. I've been buying professionally for the last 6.5 years.
Yep.
It's my company. I'm the director of Buy Side, which has been mine just over 3 years now.
Okay.
And live in Sydney's Eastern Beaches with my wife and beautiful little daughter of nearly 2 years old now. And heading on the upward trajectory, Bushy, is what I'd probably say.
I like it a lot, mate. Yeah, fantastic, mate. Tell us, why do you do what you do, mate?
Well, why I do what I do, I'm going to give you a bit of background around where I probably started from, right, which might give you an indication of maybe the person I am, I think. But I didn't grow up in Sydney. I grew up in the country up around Tamworth and Inverell area.
You're like a country boy. I'm a country boy too. There you go.
My country music taste.
You do a bit of boot scooting in your spare time, do you, mate?
No. But look, I always loved the city, actually. My grandparents lived in Sydney, and going down there, I always thought, I'd love to make this my home, and I eventually did. I went down there for uni. Pretty much the day I finished school, I was headed down to university in Sydney.
Excellent.
And I did a Bachelor of Business and Marketing and Commerce.
Can I ask what attracted you to do that? Because I'm interested in the inspiration and the decision making around why you decided to invest your time, your energy, and money on the journey. What attracted you to study that, mate?
Look, I liked the idea of business. I think probably primarily because one of my favourite topics at school, next to tech drawing, and I was headed down the path of architecture for a while, was I loved economics, and I was very good at it. And it's obviously done me very well now, because you basically need to be a part-time economist to understand what's going on. But I think that's probably what drew me to it. And I did have I still do, a bit of a creative bone in my body, and the idea of marketing and advertising, so I did three sub-majors, marketing and advertising, and the other one was management accounting. Okay. So it was I'm a Gemini, I'm very left-right brain balanced, so I'm very much about the numbers, but I'm also about the creativity side of it. And
that's a rare blend.
Yeah, and look, maybe it's a jack of all trades and master of none.
No, I doubt it.
But I really enjoy getting into both, and I really love the analytical nature of what I do now in property, and looking at the data and looking at the numbers and making sure it all makes sense.
Yeah.
But I love architecture, and I'll tell you later, but I went into interior design, and I love painting, and I do all that sort of stuff that sort of draws on my creative side of it, because I do tend to feel if I neglect it, I crash and burn a little bit sometimes.
Yeah, I know the feeling, mate.
Yeah. So just going back to that story, I ended up working tables while I was in university.
Okay.
And really by accident, I was down in Darling Harbour and saw a friend, and he got me a job, and I ended up waiting tables for about 3 years through uni, saving up a bit of money. Okay. And at the end of the degree, I thought, you know what, I'm not keen on getting straight into a corporate job. It didn't excite me, and I thought, why not go and travel the world? And I pretty much mapped out a route of the world and how I would go through it over an indefinite period of time.
Yeah.
And I was going to start in Africa, in Cape Town, right at the bottom of the Cape.
Nice.
Yeah. So I ended up saving about $26,000 at that time.
Wow, massive.
Yeah, because I was pretty much just working uni. So I didn't really have a lot to spend it on. Came out the end of it with a good side of cash. And before I left, my dad said to me, look, Josh, why don't you think about buying some property before you go? And I think...
Why did he suggest that, mate? I'm interested to understand the thinking there.
It's a good question, because we didn't have any property at that stage, and maybe that was it. Like my family was a bit of a broken family.
Yeah.
My parents divorced a couple of times, different parents, of course, but we went through a lot, and we didn't have a lot. We were always renting, and I remember my dad sometimes saying, he had seen this property up at Lennox Head, if anyone knows where that is, down near Byron Bay.
Beautiful.
And this was like 30 years ago, and he was like, "Oh, we should buy that." And his wife at the time said, "No, that's a crazy idea. It's just a shack." And anyway, I think he saw the error of the decision over time.
I bet.
And maybe it was always a regret that he had, possibly.
Right.
But I did take his advice, because I thought, well, he's probably right. I'll probably take 26 grand and just blow the whole thing. And I didn't need all that money.
Yeah.
I certainly didn't have a plan for it. And I think I was about 21, 22 at the time.
Yep.
And I thought, okay, let's go and buy something. And literally, I did one of those dumb things that a lot of buyers do. I just went out on a weekend and saw 6 properties and bought the best one on the day.
But at least you bought one, mate.
Yeah, well, that's true. I did take action, but I don't recommend anybody do that. But
no, I don't either. I'm right.
So, and I bought this little townhouse, and mate, look, it was 1999 at that time, and if anyone knew the property market back then, it was Sydney was too expensive. I couldn't get into it, and I think we all just rode the property wave for the next 4 or 5 years, and I was just very lucky, I think. And from there, I sort of looked back, and I actually stayed in hospitality for about 10 years. Working tables. I travelled around the world as I planned to do, and came back and ended up buying a restaurant up near that area around Ballina.
Okay.
And I loved my job. I loved doing what I did, and what I loved about it was the people.
Right.
I really enjoyed the connection. I really enjoyed getting out. I worked front of house and management, so I really enjoyed getting out there and talking to people and making it a real experience with the food and the environment.
Yeah.
And I have to admit, looking back on those times, I used to really miss that, because once I got out of hospitality, and this is sorry, Bushy, we've got a few hours here, but this is a long-winded story.
No, this is good, mate. This is good. Far away.
I kind of realised that, as much as I loved it, I didn't know if there was a sustainable future financially in doing something like that, for the margins that were made and the hours that had to be worked.
Yeah, right.
And it was very tough on, once you want to get serious about having a family or being remotely responsible, restaurant life is probably not for you.
Oh, the hours are ridiculous. You're like a vampire, come out at night.
Crazy. You're working like shift work basically. And as much fun as it was, there were limitations to it.
Very finicky market too, from a business perspective.
I mean, these top guys are making sort of 2 to 3% margins on their operation. It's very, very difficult to make money.
My God, that's a high volume exercise to make any money.
It is very much so. And you see these, the top chefs going out and doing they work for Qantas, and they have their own line of cutlery because they need that money to,
of course,
prop up other things.
So and obviously you could see that in terms of where that was going to head. So that makes sense. That makes perfect sense.
Absolutely. And I think at that point I thought, you know what, I actually sold the restaurant at that time, made a little bit of money, travelled around, and
well done.
And thought, you know what, I might just take a complete left turn and do something a bit more creative. And I thought, I always loved architecture, but I really wanted something a little bit more creative than architecture. And I'll explain that.
Yeah, now let's dig into that, because as you know, I was an architect for 17 years. And
there you go, mate. I didn't know that. I did not know that.
It was my first love. I was one of these kids who was very sickly and spent most of my time in bed with a pen in my hand drawing things. And Dad said, "Well,
they call it a nerd these days, mate."
Yeah, they did. I'm an absolute proud geek, mate. There's no doubt about it. And it's the year of the geek, didn't you know? But,
it's very cool these days. Geek chic stuff.
Right. But tell me the story, mate, because I had similar flavours and similar interests. So, why interior design over? Why did you see that as more creative than architecture?
I felt it was more creative because I could see that while architecture dealt with a lot of the structure and engineering was a big capacity of it, and
sure,
and design was part of it.
Yep.
Design was only a very small part, and the execution on those sort of projects, as you probably know, is 95% of the job.
No, you're right. You're right. I used to say the architecture is about 100 mils thick because it's a skin on the cake, pretty much.
Exactly.
Yeah. No, good call. So interior design. So you actually did an interior design degree or a course, or
I did a diploma with Enmore TAFE. So I got accepted. I went back to my uni and I got accepted there. And I thought actually that what ended up happening was the Enmore TAFE here actually offers a more kind of prestigious course in the design world. So I went down that route and got my diploma, and I enjoyed it. But funnily enough, I ended up going into an architect's office and working for them for free. So I kept waiting tables. It was very difficult industry to break into. So I kept waiting tables, made some money at night, and worked in the day. And I worked for a whole year for free for those guys.
Yeah, there you go, mate.
Very interesting.
Parallel with me, I spent my first 3 months working for nothing because I couldn't get a paid job when I finished uni.
That's what you have to do, right?
Yeah,
you just want it. You've got to go do what it takes.
I had to go to New Guinea to get a paid job in architecture, mate. That's a complete another story. But
wow.
Yeah, okay, interesting. So 12 months just earning your stripes really to try and get some experience. But where to from there, mate? What happened?
Pretty much. So from there, I actually I met a friend of a friend, and he had the license for Versace homes.
Okay.
And he was very high end, and look, I really appreciate sort of the high end stuff. I really resonate with the quality and things like that.
Nice.
Versace wasn't my style. I wasn't wearing it on the weekend, but but I thought it could be a good experience. And it was a very interesting job. I mean, I was basically the second hand to this main guy, and we went out to some very interesting characters' homes, and basically, did the interior work for their homes and customized the furniture, and everything was Versace, and it was a really great experience. I had a great time. And then through that, I actually, through a friend, I actually picked up a government contract doing some a government office here in Sydney, which kind of launched me into doing my own thing.
Okay.
And I ended up opening my own little studio to do whatever I wanted to do, and went into kind of renovations and that sort of thing. So I was in the inner west, if anyone knows Sydney, but we were doing like extensions and little things like that where I could make some money. And by then I was quite good at ArchiCAD and all that sort of stuff, like drafting things. And
gotcha.
I was putting in DAs and doing all this property work.
Yep.
And I thought after a while, and my portfolio was ticking along, and I thought, I actually kind of rekindled my thought around becoming more involved with property. And
because you were getting paid by project managing the whole thing, or were you just getting paid for the design of the drawings?
and the design.
Gotcha.
So I'd look after the whole thing. Small operation by all standards. And then I thought, you know what? Why don't I go out and look for projects where we can maybe add some value to?
Yep.
And I quickly realised that if I walked away from the studio, the bank wasn't going to give me any money.
No,
and,
good lesson.
It's a very short leash they keep you on,
isn't it?
But that was, if anyone's looking at property, there's always the combination of equity, which I had plenty of, but also the ability to service that debt through an income.
Yeah.
And what I effectively did was I'd go out and find projects, and I had a mate who would basically, I'd go halves with him, and we'd split the profits. So
okay,
he'd kind of put in the income component. It was basically a JV, joint venture.
You split the profits at the end, pretty much, did you?
Yeah, and we'd split the profits at the end. So I started doing that, and kind of cut my teeth on renovations in that way. Did a few courses, did Shirley Barber's course, which was fantastic. And, did my own places, and kind of got up to speed on what was happening in the property market, and also really, that's really where I hit the road in terms of going out to properties and doing 10 to 14 inspections every weekend, and talking to agents and seeing how it worked.
Yep.
And I was pretty schooled up on how buildings were put together.
Of course.
I became more accustomed to the familiarity of the languages the agents were using and how to talk to them. And because, this again, long-winded answer, but drawing back on my experience in hospitality, I was very used to dealing with people and face-to-face. And, my wife said to me later on when I got into the space, she said, I didn't think you could do it because you would come from a very different background. And I didn't think you could face up to people regularly and talk to them about, what you needed to basically sales pitches. And I said, but you've got to remember that when I was in restaurants, every single table was a new person.
Of course.
And so I became very familiar with just introducing myself and becoming accustomed to that. So I ended up doing that, and it was between projects that an agent said to me, look, why don't you think about doing this for other people? Because I'm seeing all this research you're doing and all this stuff that you bring to me, that you're looking for sites around this, and I can see the project that you've just done and all the work that went into it. Why don't you think about becoming a buyer's agent? And I didn't really know what a buyer's agent was at that time.
Just for some of the listeners that a lot of our clients may have heard the term buyer's agent or buyer's advocate, but probably don't have much flesh around the bones. Just elaborate on what a good buyer's agent is for us, mate, if you don't mind.
Sure. So if you go to sell a home these days, you are going to engage, no doubt, a selling agent, although that can be changing. The selling agent will represent you in the transaction, and they'll do everything they can to get you the best price possible for that property that you're selling. A buyer's agent is almost the complete opposite in that they work for the buyer. So the buyer pays them a fee, and that buyer's agent will go and, where it's for a home and investment, they'll go out and do all the research around what that buyer is looking for. They'll do all the running around. They'll do the legwork with both agents looking for on and off market properties, and then they handle all the due diligence. They become like a project manager of sorts in that respect, and they handle all the negotiations as well. And it seems logical when we talk about it, because who in their right mind would want to negotiate the price of a very expensive asset against a professional who does it for a living?
Exactly.
Like, how many times are you going to do it in your lifetime? Like once, twice, 3 times.
Good call.
And so we handle that whole transaction for them on a professional level. So that is effectively what was pitched to me to try, and it was really, it still is a fledgling industry. People are still getting used to the notion of what a buyer's agent is and does. But back then, it was even
pioneering
more
then. So when someone says to you, well, Josh, why would I add on your costs to the equation apart from the saving me a bit of time? What do you say to them, mate?
Well, that's a very good question, and it comes down to a lot of experience that we have. you can imagine how much experience I have in the property market now, how many people I know, how many agents we know. The analytical models that we now build into our research in identifying high growth areas or high yield areas that have prospects for the future is probably justifies the fee in itself. But on top of that, what we find is that it's definitely not for everybody. You know, it's not a $100 service. It's really for people who are effectively very time poor, and they're time poor generally because, Bushy, we work for parents most of the time. And look, I'm a parent myself, so I know what that feels like. But you know, when you've got kids, all the spare time that you thought you had has just gone out the window. You don't get time to go to movies or you know, go down to the beach by yourself or with your wife. That doesn't happen anymore. And you know, the people who we're working for typically tend to be working professionals. So both the couple is working, and they've got kids in daycare or in school, and we're going out to represent them in the market to get them the best result. That's the bottom line. Much like a great mortgage broker or a great financial planner, they're hiring a professional to go and do the job for them that they might not be able to do themselves. And even if they did have the time, they would never be able to do as well as us. Yeah,
I agree. I often say, Josh, and you probably use a similar analogy, that investing in property is an elite team sport, and the worst player on the team is generally you, because you're trying to do it part-time after hours when you can fit it in. You're better off being the owner of the team and having a team of experts in each and every position on the field who are the best at that particular role, but also understand what your game strategy is, and then coordinate and play together with the rest of the team to kick the goals that you need to achieve your long-term aims. And you know, it's a bit like the old story of if I needed brain surgery, I wouldn't go to Bunnings and buy a scalpel, some cotton wool and some metho and have a crack at it in front of the mirror on the weekend. I'd get the best neurosurgeon and his team around him to make sure that you know, I got the best possible result. And I think success in property is absolutely no different. And a good negotiator who understands the market, who knows where the opportunities are, who can find them off market before they're even listed, quite often in the general press, and then most importantly, I think, can take the emotion out of the negotiation so that they're actually getting a good result, while the client sits back and focuses on what they're good at, which is building their career and spending time with friends and families. It's just a no-brainer from where I sit. But
exactly.
What's your thoughts on that, mate?
Yeah, look, I completely agree that the fees that people pay up front are made back, tenfold. When you look at, the property is a very interesting asset in that it compounds over time. The growth compounds over time. So, small savings or small gains that you make up front on the purchase make exponential gains in years to come. And I don't think that's, a lot of people miss that. They by tweaking it just that little bit more, you get so much out of it. And we show clients this when we talk to them about models and things. But, of course we get, we can get great deals. We get properties bought under market value. We get properties that have just had, superfluous growth over and above what the average suburb will do in that area, at the same time. And just by picking the right criteria that makes a great investment. And, we've been buying for years now, and we've got models that have shown clients what and how the best investments are picked and what they look like. So I think that's probably, one of our biggest assets.
Brilliant. Are you happy to expand on what those critical investment criteria are, please, mate?
So we have a circle model of sorts, and I always say that, and I will preface this and say we are capital growth driven. We don't do a lot of high yield properties. We can, but our specialty is identifying strong capital growth suburbs that will do well over time and build wealth.
Yes.
So the model is built around that. And I always say, we take a top-down approach. We put about probably 2/3 of our selection into the area itself.
Yes.
You can buy a shack in Bondi Beach and it'll still do well over time.
Yeah, good call.
but it may not rent out, and that's where the bottom third comes in. It's very, obviously it does need to bring in an income.
Sure.
But we split the model into both risk and reward, which is very important for our clients. They've made good money over the years, but they also don't want to throw it away, by getting into something that's not going to go anywhere or has maybe got a fundamental flaw in it. One of the things that we look at on the risk side is the supply of properties going into that area. If you know the property market right now, one of the sort of Achilles heels of most capital cities is the supply of units in the inner city area where, low interest rates and a combination of many things meant the developers probably built far too much for the population coming in, and now we've got an oversupply, and it's affecting the markets and prices accordingly.
Yeah.
We also look at the vacancy rates of rentals in the area. Is this a strong market to attract tenants, because they're effectively the ones who are going to pay your mortgage.
That's right.
And of course how quickly it takes to sell. If it takes you 6 months to sell, like I talked to a couple of clients the other day who had bought out in, I won't say the town, but it's basically in the middle of nowhere.
Okay.
Far
mining
west.
Town or?
Maybe between, no, it wasn't a mining town, but it's, you're talking about probably 2,500 people.
Okay.
Well, so small place.
Why did they buy there? Because it looked good as a yield.
They bought there because of the yield.
Yeah.
All right. But unfortunately, look, these guys they're in startup mode, and they've got, they're very ambitious, very young, and they're in startup mode, and they've obviously been told a story that if the property, breaks even, it won't be a financial burden. And unfortunately, it probably won't be going anywhere very fast in terms of asset growth. And
you're not going to survive on $5 a week, are you really?
No. And look, the last thing you need, unfortunately, the Achilles heel of this property is that in that area, it takes 126 days to sell on average. Right? It's almost 6 months. Yeah. So how do you advise somebody that has got a startup company who may need to liquidate things fast in order to get out of trouble, that it's going to take them 6 months to sell one of their biggest assets? That doesn't make sense.
No,
so there's some of the things that we help clients with.
Yeah, that's awesome, mate. Well, look, let's go through a live example, because and this is a perfect fit, because the journey that we generally take people on is to get really clear on what their ideal lifestyle is. And then it's fairly easy to monetize that in terms of, once we're clear on what your perfect day, week, month, year looks like, it's fairly easy to put a dollar sum around how much income you need to sustain that lifestyle long term. And then we run them through the freedom numbers. So let's use an example of a couple who they're reasonably modest lifestyle. When they're at a point where they don't have to work anymore, they can survive comfortably on 120 grand a year. So that's their lifestyle number. Their break-free timeline, they've got 20 years to make that happen. If we assume a sort of a 5% net return on whatever they invest in, assuming it's income producing, then the nest egg number for 120 grand is about 2.4 mil. Using the old 1 times 20 rule. And if we work backwards from there, that means that their freedom number in terms of the number of properties, if we average a $450,000 to $500,000 property, is 2 properties. If we said, okay, well, this couple can comfortably afford a property around the 450 mark, they've got 20 years to do it. It is all about capital growth, because as you've well pointed out, mate, for me, this old argument of cash flow versus capital growth goes out the window when you look at, if your nest egg number isn't at the point it needs to be to generate the income, it's all about capital growth, and it's only when you exceed that number that it transitions into a cash flow strategy. So that tends to dispel that argument a fair bit to me. But let's say they can also afford $100 a week to be coming out of their pocket to fund any shortfalls on it. Given that, and throwing you right into the spotlight there, mate. What process would you take us through to identify where and what, given those sort of parameters? Can you give us a bit of a run through? Yeah,
absolutely. So first and foremost, we look at the budget. There's it's a very different conversation with a person who's got $200,000 to spend as opposed to $800,000.
Yes.
And we couple that with their risk profile.
Yep.
and their overall goal. Now, we already know their overall goal because you've identified that we're playing a long-term game for 20 years. It's capital growth focused, so we know that is first and foremost the main priority.
Yep.
With a secondary rental income of $100 a week, negative cash flow, which we can account for based on depreciation, etc. All those sort of things. So then we're going to say, okay, let's go back to our model that we were talking about before. We need to choose the right area for this property based on a $450,000 buy.
Yep.
And of course, the more budget you have, the more choices you're going to have in terms of where you can go, right?
Of course. Yeah, of course.
Now, around the 450, it's not a heap of money. It certainly wouldn't get you a lot in Sydney.
No.
But it may get you a lot in other areas like, your Brisbane market, your Adelaide market, even Perth and Darwin, but they're another story right now.
Yeah, sure.
And then we'd say, okay, once we have that budget parameter, then we're effectively putting in the same indicators into our model that we would if we were buying something at $1 million. So I'll go back to those indicators that we were talking about. Supply in the pipeline, days on market, vacancy rates. We look at infrastructure coming into the area. Is there any new infrastructure coming in to boost growth?
Yes.
Is there a gentrification happening through rising incomes? Is there population increase happening? Where is it in terms of its growth cycle? Has it experienced, 5 years of massive growth, which, a lot of Sydney suburbs have? Or is it an up and coming? And are you willing to get into something that, is potentially on the rise but may not be proven yet?
Yeah, that's brilliant, mate. How much focus do you put on the rear view mirror versus the future telescope, mate? Because it's a fine line, isn't it?
It is a fine line, and a lot of the indicators that we look at are data from, data that's at least 3 months old. I mean, even, your core logics and your top guys who are referring to the banks and advising them, they'll be looking at data that's 3+ months old. So where I tend to take it with a grain of salt, I'm not a big fan of looking at this month to month.
No.
And even 3 months, 6 months data, it's almost a waste of time in this market.
Yeah, great.
Because, you go back 6 months and look what a house sold for, and you never know what that house price, why that house price sold at that price. It could have been a bad negotiation, someone wanting to get out of it really quickly. Yeah. It's difficult to determine. However, where it does become important is where you start looking at trend lines.
Yes.
And where you start looking at your 5 and 10 and 20-year trend lines and saying, okay, well, look, this place over 5, 10, 20 years has hit 7% year on year. And there's a pretty good indication that will probably continue, all things unchanged.
Right.
Especially in established suburbs. Now, if you're talking about those outlier suburbs that are just forming in certain metro areas, obviously that's a different kettle of fish that you have to account for.
Yeah, of course. So it's something that I'm not sure whether you encountered this, but I see a lot of early investors, they might have 1 or 2 properties, jumping on the bandwagons of the old hotspot routine, which even to mention that name makes my skin crawl just quietly. But and they'll come in raving about the tremendous growth that has happened in the last 2 or 3 years in this particular area. And I often got to say to them, well, you've missed the boat. We should have been there 3 years ago.
That's right.
You jump on board now, you're likely to see 5 to 8 years of no growth. Because it's probably in catch-up mode.
That's right.
What's your feeling on that, and what sort of a chat do you have to your investors who are thinking that way?
I have 2 definitions for hotspots, and one of the traditional one is the one that you've just sort of pointed out, where you read about hotspots in the rearview mirror of sorts, where you're looking at you're basically identifying growth suburbs by the massive growth they've just had. And that's the wrong way to go about it, because what you'll find is when you watch these suburbs growth rates year on year, which we have data for that, so we can get the data for every single year for over 20 years, and you'll see that they'll do, and it's in my book actually as well, which we'll talk about later, but you'll do 1%, 2%, 5%, 18%, 24%, and then 2%, 1%, because, the markets in that suburb has exhausted itself. People will only pay so much and then they'll go to somewhere else.
Yeah.
So what you find is in these hotspots that people will identify these areas, but they're long gone. Like, as you said, the growth has happened. What you need to identify are the properties or the areas that have had long-term growth prospects but are currently undervalued.
Yeah.
And, areas that have had very nominal growth up until the point, and, it's a mathematical law, right? There's a reversion to the mean or going back to the averages.
Yes.
If you've had a 7% year average for 10 years and you've just experienced 2% and maybe a negative 1%, which is nominal, there's a good chance that there's a possible rise, all things considered. And obviously, you were looking at other things like, is there infrastructure coming in? Is there population growth? Are we seeing a falling days on market? I mean, are places taking quicker to sell? Because if that's happening, that indicates the market's starting to hot up, and that's where you can potentially get in at the right time.
Yes.
Now, where I think it's worth mentioning here, Bushy, that's not something that I promote as an investor. Because what a lot of people make the mistake of doing is that they sit on the sidelines and they analyse these numbers to the best of their ability, waiting for the perfect time, and that doesn't come.
No.
Because not only do they not know what it looks like, but they're scared to take action because they think it could get better or it could get worse. It happens the same thing in the stock market as well.
Exactly.
What I tend to find is a better strategy is to take a good understanding of where you are financially.
Yep.
Can you afford to get into the marketplace today?
Yep.
And then set a time frame and go, right, we're going to we study this market, or we're going to talk to a buyer's agent who knows what they're doing.
Yep.
And within the next 3 months, we need to have a purchase made. Now, we don't need to rush it. We don't need to force ourselves into a purchase. But if you can't find something in 3 months, there's something wrong. I feel.
I totally agree. It's you hit on a beautiful point because, as you know better than I, and I'd often say to people that we're assisting on a similar basis that if you're going to succeed in property, you've got to give yourself lots of TLC. And that's not tender loving care. It's using time, maximising leverage, and then enjoying the capital growth that will come. And the cost. I've done a number of figures on this in terms of the cost of delay, and it's not difficult. In an average capital growth area, if you stay out of the market for 5 years, and I've had a lot of clients that I've caught up with that we've got all ready, and then 5 years later they're still umming and ahhing.
Yes,
well, if
absolutely.
you break it down, it's costing you anywhere between $2,000 and $5,000 a week in lost growth.
Opportunity cost.
Yeah, massive. So I totally agree. I think that's a brilliant observation. Is set yourself, if you're serious about investing and you recognise how important time is to the end result, set yourself a reasonable time to do the appropriate amount of homework without suffering from the old analysis paralysis exercise. Get an expert on board who can find the property that suits your strategy and your risk profile and get it done. I think that's brilliant advice, mate. Brilliant advice.
Yeah, and look, mate, to tell the truth, the reason I'm so passionate about this in particular is because I've been dumb enough to make this mistake.
You and me both.
I've in years past, I sat on the sidelines, trying to be whiz bang with the numbers, and looking back, I think I sat there for 2 years and I didn't make a purchase. And looking back, I thought, I could have bought anything. And it would have made money. and now I'm sitting here, with my hand in my pockets going, I'm still looking for property.
Yeah.
It's the worst thing you can do. And it's never going to be that perfect time. These guys get into good investments and there's always a bit of uncertainty. There's always a bit of nerves. And if you're feeling that, it means, first of all, you're alive.
Yeah.
And second of all, you're taking action. That's the biggest differentiator between where I see great investors and the ones who we never see again. It's that they're out there doing something and making it work.
Yeah, brilliant. It's interesting. You talked about also the followers that get on board with an area that's had pretty rapid growth, because they want that validation before they're prepared to take the risk.
Absolutely. A lot of it's around validation and peer pressure of what they will be able to say in front of their friends.
Yeah, the whole Barbie talk and the hype and fear routine. It's really interesting. You've probably heard of this, but I was listening recently to some ABS figures that looked at the capital growth figures for the greater city areas across the nation, according to ABS figures. And interesting enough, even though Sydney's had, mammoth, I think, well, you'd know this better than me, but sort of 18% year-on-year growth the last 4 years.
Yep.
Over the last 15, mate, it's actually the worst performer of every capital city around the country. And it really put some perspective on it for me. So,
and did you read which one was the top performer?
Good old Hobart, mate.
Good old Hobart.
Yeah, and I guess there's always there's what do they say? Statistics and lies. It can be dangerous to take that too seriously in the context that the cost base of Hobart is so low that you only had to have a marginal increase in price to see a massive percentage increase. So there's danger in that, but at the same time, the take-home message there for me is that all the markets are moving in cycles, and it depends when you're getting on board in that particular cycle, and it's very dangerous to actually try and classify property market as a market, given that every property is different, every area is different, etc., etc. So, but the thing for me, I guess, is that if you're identifying properties using your criteria, which I think sums it up perfectly, and the one there that I think you've identified that a lot of people don't focus on at all is the need to have strong and growing incomes in an area so that people can afford to keep paying more for properties, because you might have all the other growth factors, but if the income level's not there to support it, then that will create its own ceiling in terms of price growth. So
that's right, and that's underpinned by jobs. Infrastructure coming into the area provides jobs. Transport links to workplaces into the city. If anyone knows the West Connex being built right now from Parramatta going into Parkway in the city, those sort of projects bring people closer to employment. Yes. And those people go back home and they have more money to spend, and hence property prices go up. Yeah. But just going back to that talk about Hobart, we actually literally had this conversation only 3 days ago in the office.
Okay.
And we were a bit kind of, I have to admit, I was taken aback by 15 years that Hobart was the top performer, and we actually ran the numbers on 20 years to see what had happened. Because going back 15 years, that takes us back to the 2003, which was pretty much the end of Sydney's boom. Right. Like, Sydney really flattened out for a long time after that.
Yes, it did, didn't it? Yes.
And I thought, okay, well, what happens if we include those 5 years that we had this massive boom? And it's really interesting because we have data breakdown on houses and units. Yep. And, the typical, the Sydney, Melbourne's came up top. I think Melbourne actually topped houses for 20 years.
Okay.
But Hobart was at the bottom.
There you go. So
over 20 years, so it's a play of the statistics, right? So very interesting.
So from 15 to 20 years, you've got a situation where Melbourne and Sydney are back at the top of the pops.
That's right.
Yeah,
that's right.
You go.
There you go. Yeah, look, watch what you've heard, and I'd also say around that is, be careful of the statistics that you do look at, because, if I say to you, look, Bushy, the Australian property market over the last 10 to 20 years has averaged 5.6% year on year, like over that period. And that for you as an investor is next to useless. Yeah. Right? As an Australian market, who cares what's happening in the Australian market, because it's so big, right?
Yeah, of course.
But then you can't look at Sydney or Melbourne or even, Brisbane, 2 million people, and think that that's a market by itself that experiences the same growth rates over every single house.
Yeah.
Hobart is the size of, I think there's less than 200,000 people there. It's smaller than Newcastle, smaller than Wollongong in the Sydney area. very, very small movements make dramatic differences in that area.
Yeah.
And while it's on a good wicket now, and I certainly won't take that away from it, the economy down in Tasmania has really turned a great turn upwards with the promotion of tourism and ecotourism and all that sort of stuff. But you can't look at Sydney and Melbourne markets as these giant behemoths and think that it can be judged under one banner. There's good parts and bad parts, and it doesn't take a genius to work out where to invest in the reasonably good parts.
I agree, and I think the danger with somewhere like Hobart, as you well pointed out, for me it doesn't really have either the critical mass or the sustainability, and it's as a tree change, sea change location. If you look at the demographics of people who are moving there, there's a lot of empty nesters and retirees, so the income sustainability is going to be questionable for me. And therefore, if I was a 10, 15, 20-year investor, I'd be hard-pressed to convince myself that Hobart will be the best place to stick my money. So
I agree.
But again, you've got a really good framework to overlay that to be able to come up with a really informed decision, mate. And that's another massive benefit of using a buyer's agent like yourself, is that you've actually you've created a science and an art around really assessing properties. And talking about that, mate, I know you've released an app a couple of years ago called Suburb Investor, which again, drawing on what we've been talking about, focuses on the importance of capital growth. Can you talk to us a little bit about that and how people might be able to access that if they want to?
Yeah, so the Suburb Investor app was, look, I'm a bit of a techie at heart. I love new tools.
You're a bit of everything, I reckon.
Stuff I can get online with and make things more efficient.
Yeah, awesome.
But I built Suburb Investor because I wanted to highlight the fact that people needed to focus on capital growth when they were looking at their portfolios. And I talked to too many investors who just didn't really have the understanding of the fundamentals that help make a property grow. And when I would talk about historical growth rates and their trend lines and where they're heading, people would look at me blank-faced, and I thought, wow, this is really interesting. And effectively what Suburb Investor does is it allows you to put in your price point invested over a particular period of time, say 5, 10, 20 years, and it allows you to choose a suburb. It's a national suburb app, so it's partnered with CoreLogic. You can put in any suburb you like, and it will give you the projected gross profits or equity position over that period of time, subject to the historical growth rate that's had over that time. Yeah, so, nice. For example, if you had invested in St Kilda, Melbourne, 10 years ago, and you had invested $500,000, what would it be worth today, and what would the equity position be? Now, that's really insightful in itself, but then I went one step further and I allowed you to compare that suburb to any other suburb in Australia purely based on the capital growth rate.
Right.
And it gives you a winner, basically. It's a win or lose situation where it's like, okay, St Kilda against Bondi Beach. Bondi Beach wins over 10 years or whatever it is.
Yep.
So you can tell, based on that single indicator, whether your investment would have been a better one year on year over that time. So, you could compare it to mining towns or all sorts of things. I mean, there's 20 years plus of data in there, I think. So it gives you the ability to use that single indicator, which I thought was really important for clients just at a very basic level. It's obviously not, you wouldn't base a purchasing decision around it, but it does highlight how important that growth factor is over time, and why you need to pay attention to what the drivers of growth are, because it will impact the value of that asset over time. Yeah,
brilliant. And it's called Suburb Investor. So if someone wants to jump on board,
if you just put Suburb Investor into the search term in your app store, it'll come up. You can download it for Apple and what's that other one people use? Android.
Yeah, that's the one. I think it's called that.
Yeah, so Apple and Android, you can get both of them. So
yeah, awesome. Now the big question that I haven't asked you really, because all we've been talking about is property, and it's a nice segue into your book. Why property? Why now, mate?
So, mate, I wrote this book about 2 years ago, I believe, and it was a labour of love. If you've ever written a book, you'll know what I mean.
I've just been through it, mate. Bushy. I've just crawled out of the other end of it, mate.
Yeah. But look, really worthwhile. I'm sure you'd agree. It really helps you refine and hone for your own understanding, your knowledge. Yeah. And one of going out there and writing another property book, there's a lot of property books out there already, and you've got to be careful that you're not, writing something somebody else has said. You've got to provide value to the marketplace, and what I drew on was I was a big believer in understanding why you were doing it in the first place. Like, what are you here for? Because if you don't have that why, then you're kind of lost. Like, you're kind of just treading water, wasting your time. You may not find that it hits your goals over the long term.
Yeah.
And the other thing that I really had going for me was that I was out in the field doing this every day. Like, I was dealing in properties and doing deals with agents, and I knew how it worked on the ground. Yeah. And I think that's where a lot of property books didn't come to the party. They told you a lot of theory, and then they kind of were like, okay, off you go. And you're like, whoa, okay. So I broke it into 3 parts. The first part is around setting a goal for yourself around property, but also defining your life in terms of how much time you want to devote to certain things. And I'm sure you cover it in that little matrix thing you were talking about earlier. But it's not all about money. It's about how much time do you want to spend with your family, and how much is that going to cost you? Yeah. Okay, let's reverse engineer that to say how much property that you need to be able to hit that goal.
Yeah, great. Brilliant.
The second part of it was around setting a strategy. Yeah. And, there are a lot of talk around capital growth versus cash flow and which one's right for you. So this part of the book really helps clarify that for people, whichever direction they want to go in. There's no right or wrong there.
Sure.
And the third part of it was really around the strategies and tactics that we use on the ground as buyers agents professionally to get a good deal. And that includes both, who you need to use in your team, similar to yourself, what you can do to avoid buying at auction. Yep. So we probably buy 75% of our properties prior to auction, which means they don't hit the auction room.
Yeah, nice.
And then what you do if you do end up in the auction room, how you negotiate, what you can negotiate on, and how to get the best price for you.
Brilliant, mate. Well, let's drill a bit deeper and ask that personal question, because we talked about, and this is a long way around the Mulberry Bush, but coming back to your personal journey, why property for you, mate? What was we talked about your father suggesting you invest in property, and that's your first one. But talk about the ongoing journey from there for you. Why you were investing in property, what strategy you're adopting, and what benefit you've got from doing so.
Okay, so I think after I purchased that first property, I had been in hospitality for quite a while, and it's a hard slog. It's 80 plus hours a week.
Wow.
And
the same as an architect and interior designer, mate.
Well, together, if you add them up, mate, probably. And I think looking back on it, it was the reality of basically when I first bought that property, it didn't become a second thought after that. It was, I'd have to send £20 back from England every now and again when I lived over there, and top up the mortgage kind of thing, and because it was remotely negatively geared. But I didn't really give it a lot of thought. And it wasn't until after I sort of came out the other end of hospitality and I thought, wow, this property has tripled in value. And I thought, I basically got, the shirt on my back and a bit of savings from my hospitality endeavours. That was before I sold the restaurant.
Gotcha.
But it was then I thought, wow, that's a really powerful tool. And, it seems like common sense now, but like I said, I didn't grow up in this environment where I was fostered as an investor, and the only time we spent playing Monopoly, I don't think I've ever finished a game with my two brothers because we ended up fighting and throwing something at each other, So I certainly wasn't your rich dad, poor dad kind of prize winner up there, but I did see the value of it, and I loved getting involved physically, doing renovations. I could just see it happen and see it work. And I have to admit, I have dabbled in share trading. I've done options.
Yep.
So I did options for
Me too, mate. Jimmy followed a similar path, my goodness.
We all have a knowing laugh around that of how much money we've secretly lost.
That's right. It's like going to the Melbourne Cup or the casino. You always talk about the massive win you've had, but you're very quiet about the whole series of losses you've had in the process.
That's right. And I think I did it in my mid-20s when probably most options traders, who were, if you did a demographic study, are probably mid-20s males who've got an ego probably bigger than it should be, and thinking, I could be really good at this.
That's right.
And I remember in the first month, I made $6,000, and I thought
that's pretty good.
I thought I was king of the world, mate. I was calling people to say, okay, set up a trust structure for me. Like, we've got to get serious about this. Of course, second month, I lost $9,000. So I was...
Mate, I've lost, I share this with people, I lost $30,000 on one trade because I technically day trade and I did all of the right stuff. You've summed it up beautifully, mate. I thought I was going to make a squillion doing this a couple of hours a day. That was the plan. There's just a transition from architecture before we got involved in the property game seriously. And I remember back testing a technical trading system to the nth degree. So I was like, this is bulletproof. Yes, I'm going to have 6 losing trades, but I'm still going to have a 40% system. Yeah, that was it was looking really good. Leapt into it, put in guaranteed stop losses, which for those who haven't traded, supposedly means that for a very small cost, you've got a guaranteed exit price when a share goes the wrong way.
Yeah.
What I hadn't factored in was that if the share price closes at X yesterday and then opens well below your guaranteed stop loss, bingo, you've taken the hit. And that was a bloody expensive lesson for me, mate. So, and I found that, I thought 2 hours a day was going to be heaps. So I ended up spending 4 hours a day because 2 hours around the opening of the trading day and then 2 hours at the end. It was a very lonely existence where I was sitting in front of a screen trying to make it happen, and it was a pretty friggin' scary ride, actually. And
I think it takes about 4 years of your life off as well through the anxiety of watching the charts.
Yeah, exactly. I say now to people, one of the key criteria for investing is that an investment's got to improve your lifestyle, which means less stress, less time involved in actually manage the exercise. So if spending 4 hours in front of a screen is part of a no-stress exercise for you, then you've got a different lifestyle aspiration to me.
Absolutely. Yeah, so look, mate, in short, I did dabble in shares and options, and I didn't feel it was right for me over that time. And I just understood property. Like I'm a very visual person. Yeah. So, I could walk into a room and I knew spatially, I was very spatially aware. I knew what could happen in a place if I needed to renovate it, what I could take out, what I could get away with. Yep. I was, had a reasonable head on my shoulders to know what council regulations were, and I could just see that, there were, provided you could manage the finance, there were big gains to be made along the way. Yep. Now that's not to say that I was trading property. I did for a little bit of time, but I have done the numbers on that, and it's actually much better in the long term to hold.
Yeah, interesting.
And I've also spoken to my grandfather who has a lot more experience than me, and his regrets were that the houses that he lived in he wished he'd owned now, because obviously they'd be worth a small fortune. But
using time rather than labour.
Yeah, absolutely. The compounding effect and leverage over time is nothing. Blood, sweat, and tears that you put into it is nothing compared to what the power of compounding will do over time to it, just organically.
Yeah, it's a good conclusion, because there's a lot of people who invest with this impression that the outcome is directly related to how much effort they personally put in. And yes, while getting the research right and doing the initial stuff is important, I think quite often once you've made the investment, you're better off getting out of the road and letting it do its work. And I've always felt, having gone down a similar road to you, obviously, with some of the earlier properties where we got pretty actively involved in physically doing stuff, leaning on friends for barbies for a carton, and then spending nights after work doing stuff, that shine wore off that pretty damn quickly. And while it was okay, it was like, well, shit, if my investment can't be standalone and allow me to focus on my career and spending my spare time with friends and family, well, is it really worth it? So I totally agree with you that if you're doing the right property in the right area and it's enjoying the right growth, then creating that second job seems to be contrary to the overall game plan, really. Is that the similar conclusion that you came to, mate? Or?
Yeah, I agree. And look, there were times where I would go and do renovations and be, head down, bum up for, I say weeks on end, but we were doing kind of not smash and grab stuff, but I'd be there from morning till midnight.
Wow.
Doing kind of your block kind of style of renovating.
Okay. Yep.
And getting in and renovating it and selling off or whatever I was going to do with it. And now I've actually found that it's more profitable just to renovate it and get somebody else to do it.
Yep.
And have me doing what I'm good at, which is, running my business.
Yeah, of course.
And then having that property sit there in the portfolio and gradually building over time. And look, I guess my position now is a little bit different. I've had plenty of sort of capital growth experience with properties and a decent portfolio.
Yep.
So now I feel I can, I guess, graduate to more complex deals where we're looking at, small developments and things like that.
Yep.
Where I feel there's some good upside both on the growth side and the income side. And there's very few
some equity right from the get-go
manufacturing
as well.
Exactly.
Yeah.
But with a qualified team, and I think that's the difference. Like the way I can do it now, I have experience in the industry, and I know people who I can put in place to get the job done, and it won't take away from my key role as both a dad and a husband and a business owner.
Yep.
And I can still get the same results, if not, better.
Yeah, great learnings, mate. And it's, I think the biggest challenge that I've seen with a lot of people grappling with is that because property is such a massive investment, people generally don't trust anyone and feel they've got to reinvent the wheel themselves. And because they know enough to be dangerous quite often, and that is, I live in a home, so let's go and get another home. That's where the wheels fall off. And you know the stats better than I. The number of investors that stop at one and 50% of those sell it within the first 5 years, I think, for me, is all about focusing too much on the property and not enough on the strategy, the structure and the financing. Because if you get those things right and it's looking after itself, then you can get on with life and do what you're good at. If you don't, then it's burning a massive hole in your pocket, creating a lot of stress and heartache. And it's the reason why people bail without going through the wilderness to see the fruits at the other end. What's your experience in that with the people that you've been looking after?
Experience in what?
Yeah, just the jumping into the property without putting the right strategy, structure, and team in place.
Oh yeah, look, it does tend to happen more than I would like, but sorry, I've just had a bit of a mental blank around that question, mate. Are we going to edit this? Because I hope we are. I just kind of zoned out there.
No, that's all right. It's late in the day. For those listening, this is pretty late in the day. So, mate, I tell you what we'll do. I'm going to jump into the future a bit now. Then,
okay.
And I wouldn't mind you putting some colour around what your ideal lifestyle looks like, what the gap is between that and where you are now, and what are you going to invest your time, energy, and money into to bridge that gap?
Very interesting question, Bushy. Look, I think if you know my story at all, I've got a little daughter. She's two in May, which has been awesome. Little Talia, she's my beautiful little girl, and I've got a beautiful wife, Julie, and she's got her. So she's coming out of obviously pregnancy and raising Talia for a small period of time, but now she's got a burgeoning career that's probably going to overtake mine at some stage. Okay. And we may have another one on the way very, very soon.
Nice.
So my priority really now is making a great life for I guess the family unit, which has never been something that I've had the experience, and I guess everybody goes through that when they first have a young family. The priorities start to change, and you need to do things differently, and it's not about you anymore. And I think one of the things that we're definitely looking at is the flexibility in our lifestyles. And Julie is on the speaking circuit a little bit, and she does a lot of consulting. So she has the flexibility to basically live anywhere she likes.
Right.
Right now, I'm very much in the field doing deals for clients and running the company.
Yep.
So in the short term, I need to be very much on the ground. But I think over time, like we both really enjoy having a lifestyle that's right in the center of everything and the city sort of buzz.
Yep.
And I've always enjoyed that. But over time, we're also appreciating the quieter kind of coastal life where we can get surfing and have a little bit of a run around on the grass, and and my daughter's favorite TV show is River Cottage, so there's got to be some chickens and some cows involved. But I do love being close to the ocean. So
nice.
I think for us, we're looking at potentially still growing what we do and growing the business and Julie growing her career, but also looking at probably a dual lifestyle where we can go to Byron or go to the South Coast when we want to and have a place there, and then get right into the thick of it and run our companies and invest, and then also be able to travel overseas. Julie's from the UK, so I love going to Asia, I love going to Europe, and we love travel. That's one of our most exciting things in our life, to be able to put that adventure into our life. So being able to fund that sort of lifestyle and make sure that we are leaving a legacy for our kids, because look, I'm 42 now, which...
You young bugger.
Yeah, I don't think of it that way, mate. But, I'm looking at, another maybe 20 years where I'm suddenly, my financial plan is starting to be like, you need to think about retirement. And I'm like, what? So, that's starting to hit home where, before I'll freely admit, on air that having a small business, over the years, super was like the last priority. It was like you didn't put money into super, you were just paying bills, right?
Yeah,
so
exactly.
My super's pretty ordinary. And
mind you, you've got your own super sitting in property, no doubt.
That's right, and that's where my wife and I have come to terms with the fact that we have invested differently in that respect, but we have to there's pros and cons with that.
Sure.
Obviously, and so we need to make sure that we're putting in the right systems now, so that in 10 or 20 years' time, it plays out the way we want it to, and we have a great lifestyle that's self-sustaining at the quality of life that we want it to, and we get to experience. I think we love dealing with people. We get to experience both the human interaction of talking to people and being in the bars and interacting, but then also being able to extract ourselves from that and go into a bit of a coastal hideaway that we get to regroup and re-energize. I think that's our ideal.
Yeah, perfect balance. So that investing in the business and your properties will continue to be the vehicles that you'll be using to do that. Is there anything differently that's going to come into your investment horizon, do you think, Josh?
Mate, the business and the property, I say business is first and foremost because, if you're not successful in the business, well, everyone's going broke and you're selling your properties. So, as a business owner, I guess I have to face that fact. It's not like I'm getting a regular wage, which is one of the beauties of working in the corporate world.
Sure.
So first and foremost, building the business, and I'm never short on ideas, and I love building the business. And that's why I had the hospitality thing, and then I had the interior design thing, because I love developing these businesses and making them better and adding more value to people's lives through these businesses and reaching out and communicating with them in that sense. So I don't think I'll ever let that go. But that then drives the subsidiary sort of asset underneath us that builds our wealth over time, that we can eventually, extricate ourselves from the system, and it'll take care of us. So that's the primary. And next to that, I would say, I think, I don't know what everybody else talks about on the podcast, but investing in yourself. Like, we're constantly investing in our own education and our own. I have a fantastic relationship with my wife where we shoot things off each other, or she'll send me a post that she saw on the net, or vice versa, and we're kind of feeding each other with how we can do things better and how we can learn, or how we can, even between ourselves, like in a relationship. Like, I just read this about raising 2-year-olds, like how they respond. Maybe we need to approach this differently in the way we talk to her, or how we act. So
awesome.
That's I guess on a different level. In terms of investing.
Totally. Level. Investing in relationship, investing in knowledge, skills, and then being able to be open enough to change. Pretty important life lessons there, mate. That's awesome. Mate, if we reflect then, so we've looked forward, let's look back. If you were talking to your 18-year-old self, you said, Josh, this is what I think you need to invest your time, energy and money in, would it be any different to what you've done?
It's a tough question to ask, because there's certain things that I know we probably all took from trading options that, there's life lessons there that we wouldn't want to get rid of. And maybe that's, the path that we all take. We all have to make these mistakes in certain areas, not to do them again.
Good call.
And if we keep making them, they'll keep appearing until we learn a lesson.
Let me put a different spin on it then, because you're right. If you were talking to someone who just finished high school, and was about to branch out into the world, from an investment perspective, what would you advise them to do?
Yeah, that's a good question. I would say that you've got to take a longer game than what you're probably currently looking at.
Yeah.
And I'm even telling myself that today, that you've got to look at the longer game.
Yeah.
There's so much magic in being young and having the power of time behind you to compound effects.
Yes.
And, putting, I know when I was that age, you blow everything you've got pretty much, right?
Yep.
There's nothing, your life will not change one iota by putting a little bit aside and investing it, and potentially into something that you can eventually leverage with. And that's why one of the reasons I love property, because there's great leverage and relatively low risk.
Yeah.
And if you can manage to fight tooth and nail and save a little bit with maybe help from parents or whatever it takes to get into a leveraged product like that, or even just a regular savings account that compounds over time, or some good blue chip shares. That what you put away at 20 years old has an exponential effect to what you have to put away at 40 years old. You would probably know as a planner yourself the difference in the amount of money that you have to do to get an equal end result is phenomenal.
It's the difference between a casual walk up a hill and a vertical climb up a mountain face.
That's right.
That's sort of analogy that probably best describes it, mate. No, that's awesome. That is awesome. A couple of what might be odd questions, but they're just little pet hobbies of mine. Mate, every one of us pays too much tax. Well, that's my view, because we work bloody hard for the money. What are some of the top things you've done to save tax over time?
Is this being recorded?
Apart from the cashies when you were doing the restaurant and the interior design game, mate, any
there's
legal
probably
things
a few
that you're doing?
Mate, I actually read this question. When you sent me this on an email, I actually read it and I thought that was a really interesting question. And if I'm obviously talking to a lot of people here, and I would say the best tax saving activity that I ever did was I got a good accountant.
Yeah, brilliant.
Right.
Yeah.
And I can't answer it any more detail. I can go into the stuff about tax structures and trusts and corporate beneficiaries, etc. But the reality is, I don't want to do that work.
No.
And it's not my job.
No.
Right? That's why I hire good professionals to do it for me, because they know the ins and outs of what should be done. And look, they set up really interesting structures that at the time when I first started, I thought was quite expensive, but now is starting to pay its dividends in terms of income distribution between the family, what we do with the kids once they've grown. And those things need to be done at the start. You can't change it once you've got into it. It can't be done at the end. So getting a good accountant on your side to teach you what you should be doing and where, based on your long-term goals, is the most valuable thing you can do with regard to tax.
Totally agree. No, great answer, mate. That's a great answer. A little weird one. What are some of the bad recommendations you hear in your game around property, mate?
I think some of the poorer recommendations are around too much focus on how the property will stack up from a rental perspective, from a cash flow perspective.
Yeah, right.
I get too many prospective clients coming to me talking about how, they don't care, too much about the property as long as it breaks even. And I say, well, do you understand that there's more criteria that goes into finding a property that breaks even?
Yeah.
It's not just, you can't just have a property that breaks even that does fantastic growth. You have growth on one end of the seesaw, effectively, in a very basic level, and you have cash flow on the other.
Yeah.
And often they're in, an opposed dichotomy between each other. So you opt for a really strong cash flow that won't put any pressure on you financially. You may find that over time you suffer, and on the asset growth itself. Now, the majority of people I talk to, Bushy, they have reasonable incomes. You could be talking 100, 150K combined, maybe probably more.
Well, interesting enough, the average combined household income at the moment, according to ABS, is 157 grand.
There you go. Yeah, most people are around the 80K mark on average.
Yep.
And what I find is that what they don't realise is that if they sacrifice a little bit of that cash flow, and they get a tax break for that through negative gearing at the moment,
good call.
They will potentially get a much greater return in terms of asset growth, because it allows them to buy in stronger capital growth areas. You see, the stronger cash flow is made in areas where the asset price doesn't go very high, and that's why it's a stronger growth, a stronger rental yield in comparison to the price of the property itself.
Exactly.
Once you start getting into stronger growth areas, the rentals get left behind, which is why the yield looks so bad. And if you can afford to put away a little bit, and this is, I guess, the idea of investing, you sacrifice a little bit up front. What you'll find is you get it back tenfold on the other side, which is the capital growth side.
Absolutely right. And really good analogy. And I often have a similar discussion where the difference between 5% growth and 8% growth over a 20-year journey, if you're buying a property of $400,000, is over $800,000 in terms of what you end up in your back pocket, mate. So it's and that's the difference. Where if you're just focusing on, I don't want this to cost me anything, versus I want to maximise the growth, then they're two completely different results. And it's it's interesting that you recognise the value of that and clearly educate those that are dealing with you on the benefits of doing so, mate. Which is a really important distinction that often people don't. That they're looking at now rather than the future, I think, is probably part of that to some degree. Awesome. Mate, a couple of things then, and I'm mindful of your time, and I feel like we've only scratched the surface and could talk forever on it, because we clearly share the same passion for property as a vehicle to create freedom. A couple of little things to share then, mate. Are there any quotes that you live your life by, or quotes that you think sum up your outlook on life that people would get something out of?
Mate, one of the quotes that, so I'm on Instagram and Pinterest and all that stuff, and I collect some of these quotes, and the one that really resonates with me and that I loved when I read was by Muhammad Ali. Okay. And he said, every day in training I wanted to quit, but I told myself, suffer now and live the rest of your life as a champion.
Brilliant. That's
which I loved because, it's one of the things that I talk about to investors is about mindset. And if you've done anything that's a struggle, or if, you've run your own business or gone on a big journey that really was quite taxing, you'll know it's all about mindset, and it's about overcoming the struggle that we all deal with internally.
Yes.
And, to look at someone like Ali and think, that man, he was just the same as everybody else. He went through everything the same way we did internally, but he had this vision that, he was going to become the champ, and that's what he did.
Absolutely. And it's the things that you're alluding to there in terms of the discipline, the passion and the persistence, just to keep focused on the end goal and work his way through the desert, that probably separates him from a lot of others who just don't have that fortitude to keep on going.
That's right, mate. It's all about persistence.
It's a muscle that doesn't get much exercise these days in our instant iPhone and everything. Well, mate, I find. But
it is an undervalued asset.
It is. I think it's ultimately the big separator. But, mate, apart from your book, Why Property, Why Now, what other book do you think listeners could get a lot of value out of?
Well, mate, it's got to be your book, right?
God, we're doing the back scratching thing here, mate. I'll send you the money in the post, all right?
Look, good question. One of the books that I tend to read a lot of books when I'm on holiday, and if you're, I'll just pick out one. I think this one has probably moved me more than any in the most recent years. Okay. And it's by Anita Moorjani, and it's Dying to Be Me.
Okay.
And it's
Tell us about it.
It's about a woman who was riddled with cancer.
Okay.
And she effectively died in hospital.
Wow.
And then came back and recounted her life and her experience while she was effectively, clinically dead.
Wow.
To the point where she could recount the conversations by doctors in the hospital at the time. Wow. But she went through a lot of experiences and had an amazing epiphanies in that experience alone. That I guess it's on a spiritual level that really highlighted some really interesting things, and she was later picked up by Wayne Dyer, if you know Wayne.
Yeah, I do. Yeah.
One of those big sort of spiritual guides back in the day, and he went on tour with her for many years, and subsequently died of cancer himself in the most recent years. But amazing. Like, I found it an amazing book personally, and
that's awesome. I haven't heard of that one, so I'm adding that to listen. We'll make sure we put that in the show notes, mate, because it all comes back to that why, doesn't it? And probably the recognition of how precious a gift we have with a life we lead, and then giving us the inspiration to make sure that everything we do today is helping to sustain that down the track,
and that we focus on the right priorities. I think I can give you, literally, I've got like my Kindle open here. I can give you 20 business books that I've just read, which will only keep your nose to the grindstone. But I find, sometimes those other books give you some perspective.
Yeah, no, awesome, mate. That's thanks for sharing. That's I'm added that to the list myself because I'm a very avid reader, and my Kindle just about bursts with books that I love to read. So thanks for that, mate. That's awesome. Mate, in drawing it to a close then, what are you investing in the moment, mate, that people might be interested in hearing about?
Well, without question, my business is probably taking up the majority of my days at the moment. We're looking to expand, which I talked to you about briefly before the call, and what that will mean, and also I guess expanding that level of education that we give to our clients and the greater sort of community around investing in property, etc. And then on the property front, we're currently looking at a development site up in Brisbane. I won't give too much away, but that's
What's the address?
That's one of those things we can add value to. We're subdividing and putting some really interesting housing on it that looks at both the capital growth side of things and potentially the income on a longer term level. So
awesome.
Yeah, very exciting, mate. Keeps us on our toes.
Yeah, absolutely. And if any of the listeners are keen to follow you up for you to assist them with Buyside in relation to helping them to secure property, how do they contact you, mate?
You can contact us through the website, which is www.buyside.com.au. You can reach me personally at josh@buyside.com.au. And look, if you want to get really personal, which I love doing on podcasts with you, Bushy, it's 0416 172 900.
Brilliant, mate. We'll stick that in the show notes as well, mate. In drawing it to close, then anything else that you'd like to share with us that I haven't given you an opportunity to touch on?
Mate, nothing springs to mind. I have to thank you for having me on the show. It's a real privilege and an honour to be here.
Likewise, mate.
You've got an immense amount of experience, both with your team and yourself in this field, and it's great to be sort of counted up there among those. And I wish you all the best. And look, to anyone listening, I applaud you for actually getting out there and investing a little bit of time in your own education and how you can better yourself, and the payoff will be well worth it. Yeah,
great advice, mate. As always, mate, I am keen to make you a regular on the show. What I will be looking at doing over time is just doing a periodic review on what's happening nationally around the place, and given the work that you're doing in that regard, if you're open to it, would love to get you on board to do a scoreboard run around the country just to get a flavour for where you think the opportunities in the future growth are going to come from. So,
I'd love to do that.
Yeah, it's an area of interest that most investors are pretty keen to find out where things are heading. So we'd love to have you on as part of that exercise, mate.
Well, I'd love to be on there, Bushy. I appreciate that.
Excellent, mate. Well, look, thanks again, mate. It's been awesome. Looking forward to continuing it. I know you're going to continue to kick some major goals. You're clearly a disruptor, and I love the fact that you're one of those rare people that left brain, right brain, creative as well as a people person, mate. That's a very rare combination. So I can see why you've done so well and will continue to do so, mate, and love the fact that, with the young and growing family, you're recognising the benefit of creating time to look after their legacy, mate. So keep up the great work, and we'll look forward to talking to you soon.
Thanks, Bushy. Thanks for having me, mate.
Thanks, Josh. Cheers, mate. How good was that? I hope you enjoyed it. To get a summary of all the investment gold and to get a copy of the show notes, email me on hello@khgroup.com.au. That's HELLO@khgroup.com.au. Or check us out at www.khgroup.com.au/get-invested. And join me next week for another episode of the Get Invested podcast. Thanks for listening.